A condo that sailed through financing last year can flat out fail to qualify this year. And the buyer did nothing wrong. Same building, same price, same strong credit. The thing that changed is a set of rules your lender is reading right now in documents you have probably never seen. And if you are buying or selling a condo this year, those documents decide whether your deal closes or dies. So let me tell you what's going on, because most people walk into a condo purchase thinking the rules are the rules, and they have been the same forever. They're not. On March 18th of this year, Fannie Mae and Freddie Mac, the two giant agencies that buy most home loans in the country, released coordinated updates that reshaped how condos get financed. Fannie published it as a lender letter -03. Freddie published its matching version as a Bulletin -C. Same day, same direction. And here is the part that catches buyers off guard. The rules are not about you. They are about the building. Let me explain that, because it's the whole game. When you buy a single family house, the lender mostly looks at you, your income, your credit, your down payment. When you buy a condo, the lender looks at you, and then it turns around and reviews the entire homeowners association behind the building, the budget, the reserves, the insurance, the repair history. If the association fails the review, it does not matter how perfect your file is. The unit becomes what we call now non-warrantable, which just means the big agencies will not back a normal loan on it. And when that happens to one unit, it usually happens to every unit in the building. So what actually changed? 3 things that matter most. And I'm going to save the biggest one for last, because it is the one nobody sees coming. First, reserves. A reserve fund is the savings account an association keeps for big future repairs. Things like the roof, the elevators, the parking lot. For years, the rule was that the budget had to put at least 10% of its money into that fund. Starting with applications dated on or after January 4th of next year, that minimum climbs to 15%. Picture a building that collects $1 million a year in dues. Under the old rule, it set aside $100,000. Now it needs to set aside $150,000. That is a 50% jump in one line of the budget. And a lot of older self-managed buildings have no idea it's coming. Now, there is a way around that flat 15%. If the association has a professional reserve study done in the last 3 years, the lender can use that instead. But here's the catch that trips people up. The budget has to fund the highest amount the study recommends, not the cheapest option, not the bare minimum. The old trick of keeping reserves hovering just above zero is gone. That method is no longer allowed at all. Second, insurance. The agencies put a hard ceiling on the master policy. If the building's insurance has a per unit deductible higher than $50,000, that alone can knock the whole project out of conventional financing. That kicked in July 1 of this year. There's some good news mixed in here, too. Roofs can now be insured at actual cash value instead of full replacement cost, which gives struggling associations a little breathing room on premiums. But the deductible cap is the one that bites, because some buildings quietly raise their deductibles sky high just to keep their premium low. That move now backfires. All right, here is the big one. The change most buyers will actually feel. And it is the reason I made this whole video. For more than 20 years, there was a shortcut called the Limited Review. If you put enough money down, the lender could skip the deep dive into the association and approve your loan on basic information alone. Roughly 40% of condo loans in the country use that shortcut. As of August 3rd of this year, it's gone, retired. For any established building with more than 10 units, every loan now goes through a full review. Let me tell you what a full review actually means for you, because this is where deals get slow or fall apart. The underwriter now has to pull and read the association's budget, its financial statements, the reserve study, the delinquency rates, the meeting minutes, and the insurance documents. If a structural inspection was done in the last 3 years, they have to get that too. And if it shows critical repairs that have not been fixed, the building is ineligible until they are. So picture you are buying a unit and the Sellers Association is run by a part-time volunteer board that takes 3 weeks to send a single document. Under the old shortcut, none of that touched your closing. Now, it is the difference between closing on time and watching your rate lock expire. And this is exactly why I do not want you finding this out the week before closing. The smart move is to have someone pull the current bulletin language and run your specific building through the review before you are emotionally attached to it and money is on the line. A great rate means nothing if the building cannot pass. So, if you are eyeing a condo or you own one and you're thinking about selling, send me the building and let me check where it actually stands against these 2026 rules before you go any further. That is the real answer, because it depends entirely on that specific association's numbers. And that is what I do every day. Book a call with me using the link right below this video, and I will run it for you. If this cleared things up, subscribe so the next person who needs it finds it too.